All right. Good afternoon. Today's topic is forecasting exchange rate. Right? Forecasting the exchange rate forecast, that is important, like factor or input in many decisions, in a number of decisions. For example, hedging decisions on foreign currency. I mean, that's therefore that decisions, the like reasonable, rational forecast of exchange rate will be important input. And short-term investment of excess cash, excess capital, that should be, for the good forecast of that, of the exchange rate, will be important factor for that. And also, it is important, the forecasting is important for parent firm's decision on capital budgeting decision, or parent firm's decision whether the foreign subsidiary reinvest its earnings or remit the earnings back to the parent company. It depends on the forecast of future exchange rate. And long-term financing decision in the foreign capital market, also this forecast of the exchange rate is important factor for that. So, okay. Okay. Next page, next one. Okay. Here we have different techniques there. Okay, let's talk about the major techniques of forecasting exchange rate there. So roughly two different categories, two types. One is model-based method or market-based method. All right. So model-based method. Okay. We have technical forecasting and fundamental forecasting. All right, let me Madison.
Yes.
Yeah, can you read that the technical forecasting for us?
Yes.
Okay.
So recurring pattern in price and volume is used for forecasting, charting, bar charts, and extrapolation techniques, trend analysis.
Okay.
Then
and limitations.
Yeah.
Wait, just limitation can, okay. Rachel, can you read limitations?
Yeah, so limitations focuses on the near future. It rarely provides point estimates or range of possible future values. Performance of the method is different from period to period.
Okay, let me explain technical forecasting or technical analysis. I think when you look at the investment analysis, security analysis, one important group is also called technical analysts. So they use this approach, this methodology in stock price analysis or security analysis. Here, they use the same approach on foreign exchange rate there, right? They're same group, similar groups with the similar techniques, similar the methodology there. So let me just explain this one. I'm gonna briefly explain this, okay? They try to identify some kind of recurring pattern or in the price and volume or some recurring trend so that they can use that for forecasting. And also they can use that for their profit or their benefit there, right? If the investors, the foreign currency investors, foreign exchange investors, or speculators, they use this forecasting for their benefit, right? For their profit. And the corporation, multinational corporation, they use this one to what, to here, multinational corporation there, they use this forecasting. They forecast the exchange rate for their hedging decision, their short-term investment decisions, and their capital budgeting decision, and also either reinvest or they're remitting the earnings to the back to the parent company, or long-term financing their decision in foreign capital market. All this one are the decisions related to forecasting. So multinational corporation, they do that, okay? And like important figure of in the technical analyst or technical forecasting is they use charting, bar chart or extrapolation techniques or trend analysis, all those kind of things. Look at this chart. Now, let me introduce a couple of important concept or terminology there. Resistance level, the chart, resistance level and support level. Resistance level is like, this price is not likely go over the resistance based on past information. If there is a resistance in there, right, beyond this level, it is called resistance level. Right? If it is support level, is that the price is not likely to go below this support level. If you identify that kind of level, that is called support level. But sometimes it goes down the support level, then that is like either that should be old like support level. I mean, here we see the current support level, right? But it could go back down to old support level, or it create new support level, which is lower than the current support level there. Breakout is called breakout there, right? So go down. So we probably give you new support level, or going down. If you look at this one, trend. So this one, it has upward trend, right? This is called bullish trend. This one is downward trend, is the bearish trend. And again, followed by bullish trend and bearish. So if you look at the interesting thing is that it's called double bottom here, right? I'll explain that one here. So as I said, this technical analyst, they try to identify some like the trend, identifiable pattern or trend. Okay, so two famous like pattern is the second one here. Look at this, head and shoulder. And then this one is the double bottom, right? Double bottom. So let me explain briefly. Now, what they believe is this pattern. If the price, stock price or exchange rate, currency price increases, it hit the top there, right? Hit the top, but it's not the real top. It goes back again and then hit another second top. That is the top. That is the head. This one is shoulder, right? Shoulder. And then the next one is top is the head. And then go back down and hit this one, this one is another shoulder. So it's called shoulder, head, shoulder. Well, or shoulder to top, head to shoulder. This pattern is one famous pattern that they suggest. Another famous one is if the price goes down, if economy or your stock price goes down, it hit the bottom, but bottom and then recover. But what they believe is that it's not that simple. Hit the bottom and recover. It's not that simple. Hit the bottom recovery, but it goes back again and hit another bottom and then recover. So look at this. This one is double bottom, right? Double bottom. I think you heard about this one. Double bottom, and then this one in the head, the shoulder, head, shoulder pattern. All right, and also, some believe in the opposite. Is the double top, right? Double top, and this opposite is like inverted head and shoulders. Okay, so why do they need, I mean, how do they use this pattern for their investment? Now look at this one here. I mean, this one, let me explain this. If it is double bottom, if the currency value hit the bottom and then improve and hit the bottom. So if you identify this double bottom and then goes this way, then what do you see? Your future forecasting is now it will increase because of this double bottom pattern. So if this one is your projection, is the analyst projection, then how would you use this pattern to get the profit? You invest in call option. You buy call option. If you buy a call option, right, and then when the price goes up this way, and later on you get the profit, you get the delicious sushi lunch profit. All right. Now, if you look at this one, head, shoulder, I mean, shoulder, head to shoulder. If you identify this one, how do you use this one here? Now, if you hit the top and another top and small another top, then you expect it will go down because of this pattern. So in this case, the price goes, I mean, the currency price will go down this way. And then what do? Your action will be buy put option, right? Put option. Then in the future, if the price goes down, you can enjoy that. Enjoy you because you have the right to sell at this price, higher price in the future when the price is market price is low, right? And another like pattern is rising wedge this way. If you see this way, then you probably want to buy put. If you this kind of falling wedge, then you probably want to buy call option, right? Does that make sense? Based on what they suggest, it makes sense. Now here, the trend line. If you see trend line, now interesting thing here. This first part is the trend line works as the support line, right? Now resistance line level, and then here in this, I mean, in this side, it shows like like support level, right? For this period, and then reversal this way. Now, some people, I mean, investors, speculators, investors, they use this pattern there. So an oversold, overbought, and oversold pattern. This one, this goes down this way, swing this way, right? This way, kind of just swing this way. And their strategy is, if it's oversold, then you have to buy. Okay. If it is the overbought, wait a second, overbought, right? This is overbought. This is oversold. So in this case, what would you do? I mean, right, yeah, okay. It is. So this overbought and oversold is called oscillator like pattern, right? Now, based on the depending on the overbought pattern, oversold pattern, you can make your selling decision or your sell decision or buy decision there, right? So if it is overbought, that means it goes down there, right? So if that happens there, then in the early stages, you want to sell it, right? You want to sell it. If it's oversold, right? Oversold, If it goes into the stage of oversold, then you want to buy that. You want to buy that. That's one type of group, who use this pattern for their trading. Now, another usage is here. Look at this. You heard about the moving average, right? Moving average. This pattern is the actual exchange rate, and this blue line is the moving average. Moving average. So one trading strategy would be if the actual price goes below the moving average from top to bottom. If the exchange price cross moving average from top, that's the buy point. Buy point. See, every time it hits moving average from the top, then that's the buy point. It's a buy point, right? If hits from below, then you have to consider selling point. Is this another strategy, another the decision for sell and buy there? So this kind of group, this kind of analyst, or this kind of forecasting, it is called technical forecasting, right? So what they do is that they use past price and past the transaction volume to figure out any trend or pattern, and then they use this the trend or pattern for their execution of their trading. Okay, forecasting here in the forecasting. All right, fundamental forecasting. Let's see. Somebody read this one for me.
I can read it.
Yeah, first part.
Just the under fundamental forecasting, that chunk there.
Yeah.
Okay. Future ER determination depends on some fundamental macroeconomic and policy variables. Relative inflation, I, US minus IF. Relative interest rates, I, US minus IF. National income growth, G, US minus G of F. Changes in money supply, M of US minus M of F.
Okay. And somebody else? Jacob?
Oh yeah, all right.
Yeah.
Regression analysis to estimate the forecasting model. EV equals
You don't have to. Go next.
Okay.
Limitation.
All right. Limitations of fundamental forecasting include unknown timing of the impact of some factors. Forecasts of some factors may be difficult to obtain. Some factors are not easily quantified, and regression coefficients may not remain constant.
All right. Okay. Now, if you look at the technical analysis forecasting, this one is focus on the very near future, right away, soon, and it does not. This one shows pattern or trend, and based on this pattern trend analysis, you make your sell or buy, right? Sell or buy, but it does not provide point estimate or range of the possible future value. It does not, right? And then performance of the method is different from period to period. That's the limitation. Now, fundamental forecasting. Fundamental forecasting, they come up with the forecasting model. So mathematical or quantitative model. Now, the model with the relevant variables, fundamental variables. Those fundamental variables include macroeconomic variables or policy variables there. Now, the widely used variable is relative inflation, right? Relative, we know this one, right? This one from the exchange rate determination in chapter 4. So relative inflation was the important determinant. Relative interest rate, that's the important determinant. National income growth and money supply is also important factor there. Okay. So based on this macroeconomic or the policy variable, the first three is the macroeconomic variable, and last one is like policy, monetary policy related variable. Yeah. So they come up with the some regression analysis to estimate forecasting model there. Like E small e is the change, percentage change in exchange rate. So expected percentage change of exchange rate is a function of relative inflation, relative interest rate, and relative the national income growth, and relative the money supply, right? Money supply change. All right. So if we use the one example there, suppose this fundamental analyst, fundamental forecasting model is for euro is 0.0 here. It's a function of this. Yeah. 0.1 plus 0.06, that is the relative interest rate, plus 0.04 times relative inflation. Suppose that is our fundamental forecasting model, then given our relative interest rate is 2% and relative inflation is minus 1%, what would be your predicted percentage change in euro? Now, it's simple. Just enter this. Enter this relative interest rate in here, and then relative inflation in here. So let's calculate this one here. So 0.1 plus 0.6 times 2% plus 0.4 times minus 1. Minus 1 is what? We have 0.9. Is it 0.9? Yeah, 0.9%. 0.9% is what? That is the expected the percentage change in euro. So that's a 0.9%, right? 0.9%. So if the current euro is $1.20 per euro, 1.20, then what is your expected value of the exchange rate for next year? Simple. 1.2 is the current one, right? So 1 plus 0.009, 0.9%, that is the next year's like exchange rate for euro. So 1.2108, that is your forecasted euro exchange rate for next year. Okay. All right. So we got this one here. Now, limitation of fundamental forecasting. Now, unknown timing of the impact of some factors. All right. Now, let's look at this one here. Now, we have this determinant variable, relative interest rate. Interest rate is always related to money supply, monetary policy, right? Interest rate. This relative interest rate, the timing of the impact is like quite short. So impact will come out like shortly. However, relative inflation, think about inflation. Inflation, it takes time. It takes longer time for relative inflation to start to have real impact on the exchange rate. So I think one of the problem that you will see is this one is, one of the problem that you will solve is this one is T, the timing is T, but this one, the inflation timing is T minus 1. And then in the same in the forecasting model, right? The expected percentage change in the exchange rate. Look at this one here. This one, the current interest, the relative interest have impact sooner, but this one is T minus 1. So we use lagged variable. So it was last year's, like, inflation, relative inflation has impact on the expected exchange rate. Yeah. So this way you can explain, or you can take care of this impact, the different timing of the impact of these two factors. That's one way. There's one way. Okay. I mean, you can find this one in your problem. And forecast of some factors may be difficult to obtain. Now, you have to get this, like, this variable. You have to get this reasonable, variable, or reasonable the expectation, right? So to come up with this one here. But sometimes some variables forecast of the or of some factors may be not so easy, right? That's another one. Some factors are not easily quantifiable. One of the, do you remember that one of the major determinant of exchange rate is expectation. Remember that? Expectation. The markets or investors' expectation. There is the important measure, important, like, determinant of exchange rate. Well, how would you quantify that expectation? You can. That's impossible, right? And then regression coefficient may not remain constant. Do you see that? I got 0.1, 0.6, 0.4 based on the past the regression analysis. Now I'm going to use this estimated coefficient for your future prediction. But this one, these numbers, this estimated coefficient may not be stable over time. If they are not very stable, then this predicted value, 0.9%, might not be very, acceptable sometimes. Okay, so that's the limitation for this one here. Now, second group of forecasting is called market-based forecasting. This one uses, like, all different the market equilibrium things we talked about before, right? So if you look at this one, the first one is the forward rate to forecast the future spot rate. Do you remember that the last parity or equilibrium condition was forward rate as an unbiased estimator of future spot rate, right? Meaning this, remember this? Forward rate is an unbiased estimator or predictor of future spot rate, E1. Okay, so we can use this idea, this parity condition, this parity condition, the concept. Now expected, change. I mean, not expected. Yeah, expected change in the foreign exchange rate is, if you just put this one, use F as unbiased estimator of future E1 there, E1. So F minus E divided by E, that is, like, unbiased estimator for expected percentage change in exchange rate. You see what I mean? This one forward rate is unbiased estimator of future spot rate. So future spot rate minus E, the current spot, divided by current spot, that is the percentage change in the currency value, right? Exchange rate. So that's one way. Second, we can use the purchasing power parity. So purchasing power parity, remember that we use that the relative inflation in that forecasting there. So typically this purchasing power parity is good for, like, long-term period, long-term horizon, beyond 1 year. So euro if the euro is currently $1.20. Now, inflation rate for US and Germany is this way. So what is that? US inflation is 3, German inflation is 4%. So you use this information and to predict the future spot rate. So E1 is E0 times 1 plus I US, the inflation US divided by 1 plus I UK. Remember that, right? That's the purchasing power period. Let's calculate. 1.2 times 1 plus US inflation 0.03 or 3%. 3% divided by 1 plus German inflation 4%. Now, so we're talking about German euro, right? If the German inflation is higher, then without solving this one, without even calculating this one, what do you expect? If German inflation is higher, what do you expect the German exchange rate? Based on PPP, it should be weaker, right? Should be weaker. So your answer is 1.1885. See, because of this, higher inflation in Germany, German euro is expected to depreciate next year. All right. Now that was 1 year, right? 1 year, but 2 year. If you do 2 years, you just simply square it. Okay. So put one more. 1 plus 3% divided by 1 plus 4% here, and what? Square it. See, it depreciated further. 1.1770 in 2 years. So that is how to use this, the market condition or market equilibrium parity condition to forecast future spot rate. All right. And then we can also use the international Fisher effect there, same way. Right. The pound is 1.40 and the 5-year interest rate is 5% in US and UK 8%. So 1 plus 5% divided by 1 plus 8%, right? So it should, oops. Okay. 1 plus, what's going on? Oh, times, yeah. Okay. Here, times, right? Right. So based on this international Fisher effect, next year's the pound value will go down, depreciate to 1.3611. Now for 2-year period, 1.40 times 1 plus 5% divided by 1 plus 8%, 2-year squared. Oops. Oh, 8%. Okay, 1.3233, right? Down to 1.33. Okay, that's how this is like, market-based forecasting. Okay, and then this model that we used was what? The market equilibrium or parity condition. Right. Mixed forecasting is the combination of these two forecasting techniques. So they come up with their different forecasting forecasting the value, and then then you can get the some kind of weighted average of those the multiple forecasts. So you calculate based on like international fishery fact, and then purchasing power parity, and then the forward rate using forward rate, and then you get the weighted average of those. That could be that could be one way. Guidelines for implementing the forecasts, you know, apply forecast consistently within the MNCs. You know, if you use this forecasting model, you have to use the same approach for every the subsidiaries, everything, right? Everything. If you lose consistency, then the outcome, the forecasted outcome, might not be so like acceptable. Measure impact of alternative forecast. Consider other sources of the forecast, right? So if you have any other exploitable information or the resources or forecast, other alternative forecast, you have to pay attention to that before you make your final like forecast. All right, last one. Now, how do you evaluate the different forecasting methods? You have to know which one is more precise or which one is more consistent. So you use forecast error, measure forecast error, and then based on that forecast error, you can make your decision or evaluation of different approach. So widely used measure is forecast error. Forecast error is the predicted value minus actual value. So if it is over predicted, then it gives you positive forecast error. If predicted value is underestimated, under predicted, then it should be a negative, right? Okay. Thing is that the potential forecast error for occurrence depends on the forecast horizon. That means if you are looking at 1 month versus 1 year. So 1 month's forecast error would be smaller than 1 year forecast error. That's definitely. If you look at the 1 year, 2 year horizon, your volatility will be much higher, right? Much higher. So your forecast error will be higher. And forecast error for a given currency changes over time, of course. The ability to forecast error may vary with the currency of the concern. Right, look at this. Yeah. Different countries like volatility is here, right? Chinese yuan, Singapore dollar, Japanese yen, Canadian dollar, pound, euro, New Zealand dollar, Australian dollar, Brazilian real there. See that? So the higher the volatility, the higher the forecast error. I told you, right? Forecast horizon. Higher forecast horizon, that gives you higher volatility, and forecast error will be higher. Or different for currency. Now look at this one here. The pound versus real. Pound versus real, yen, pound, euro, they are here. But the other New Zealand and the real, they are higher. This Chinese yuan is very peculiar one. I mean, it's very low volatility and low the forecast error. This one, is like unusual because this Chinese yuan is like, usually highly controlled by the government. So they're not supposed to. I mean, but they control the exchange rate, yuan, Chinese yuan, and they also control their interest rate and their inflation or wage they have strong control over their like this macroeconomic variables like foreign exchange. Okay, we understand, we know that the foreign currency are supposed to change based on the market forces, right? Invisible hand or in the market. But here is different. Chinese government, they have strong control over this yuan. Now, that is, you heard about this one. That is one big complaint by the other country, like US government and other European government. And you are not supposed to do that. You just, the Chinese government, you just leave yuan to the market forces. Because government control means very stable, like Chinese yuan, or low level at the low level. That means the benefit to China in terms of the trade balance. Okay, so that's the target. That has been the target of many countries toward Chinese government. Right. All right, let's apply this one. I mean, the absolute forecast error as a percentage of the realized value. Forecast minus real, actual, divided by actual. All right, let's do it. So, Polish zloty is, we read it zloty, but in their Polish pronunciation, L, there is one slash L. L, you don't like pronounce it. So the correct pronunciation is Swati, not Zloty. So when I go there to get that country, I just pronounce it Zloty, but that's not the right way. But in there, the original the pronunciation is Swati. That is the Polish exchange rate. Sometimes I told you that I teach at the University of Warsaw University, the MBA program, over the summer, every summer. But last year it was not. I mean, this year because of this COVID situation, we couldn't go. I couldn't go. But some year I feel happy. Some year not so happy. Sometimes when I have $1, sometimes I get like four or more than 4 zloty back when I change currency from dollar to zloty. Sometimes I get only 3 zloty. Well, what does that mean? Look at this here. 20.20. I mean, the realized value. Look at the realized value. If it is 0.20, then I could get 5 zloty, right? 5 zloty. But if it is like 0.26, I get for $1 that I give, I get only 3 zloty. You see what I mean? Sometimes I get the 5 zloty. Sometimes I get only 3 zloty. So if I get 5 zloty, I feel happy. If I get only 3 zloty, I feel not so happy because for $1, the amount of my spending there in the Polish zloty is different. Sometimes I get only 3 zloty. Sometimes I get 5 zloty. So that's, if it is, it is just $1, but if you think about $100, think about $100. Then sometimes I get 500 zloty, but sometimes I get, I get only 300 zloty. That's a big difference. You see that? So sometimes that makes me feel very happy, sometimes not, depending on the exchange rate. All right. Polish zloty. Now, Now there's two approach model 1, model 2, right? And then let's evaluate these two. Okay, so again, to evaluate the measure, I mean, the tool for evaluation is to calculate forecast error. Let's use this absolute forecast error as a percentage of the realized value. Let's do it. So what you do is ABS, that's the absolute value, right? Absolute value of the model 1. Let's do model 1. Predicted minus real. So predict minus real value. All right, that's absolute value. So that's a point. Oh, no. You have to do it, right? Did slide to percentage. Don't remember either way, but it says forecast error. Oh, okay, forecast error. This one just use the forecast error. It is not the percentage as a percentage. So 2 minus realize that's the 8. Okay. So it depends. It's up to you, right? So this one is just gave you the absolute the forecast error, right? Absolute value forecast error, and then this one forecast error that for model 2 is realized forecast minus realized value. All right, so you did that, and then once you did that, you could do copy and paste. Right? All right, look at this. That is what absolute value of forecast error. See that? Now let's calculate. Right, this one should be. No, the sum is this, and then. Right. All right, look at this here. If you sum them up, the absolute forecast error is much bigger for the model number 2. So you can get the feel, right? Then also average of this model 1 versus model 2. What do you do? Now, based on this this outcome, this calculated absolute forecast error, which one do you think performs better here? So absolutely, the model 1 that performs better, quite better. Okay. All right. So probably here model 1 you don't want to just ignore model 2 because is inferior, or maybe I think there should be some justification for model 1 and model 2. So you have to pay attention to that, and then based on this, the absolute forecast error, it turns out that model 1 looks superior, right? So in this case, probably either you could prepare M1 model 1 as a forecasting model, or you could get like kind of weighted average of those two. So meaning like more weight on the model 1. Okay. So you don't want to just ignore the model 2 completely, because model 2 probably has its own justification for that approach. Okay. All right. I think that's it for today. Do you have any question? So as I said, it's a short version today. So, okay, what did I do? Stop and